I'm going to let everybody pile in, but while we do, let me move out of the way here. I have a quiz for everyone, and I will give you the correct answers. There are no prizes or grades, so that could be a good or a bad thing depending on how you like quizzes. But just take a second and see what you think the answers are. And by the way, it's a matching, so each of the three answers is 3%, 8%, or 70%. What percentage of Americans over 65 will need long-term care? What percent of Americans who think it is very likely that they will need long-term care? So actually versus think they will, and percentage who have long-term care insurance. Let's look at what the answers are. So percentage of Americans over 65 who will need long-term care, 70%. That probably, if you're like me, when you look at that number at first blush, that might not jive with what you kind of expected. Maybe based on the answers that I gave that were available, you might have guessed that correctly, and congratulations. But the actual results, given that the fact that 70% of people over 65 will need some form of long-term care, that's sort of surprising because you hear all the time about these people who don't use it at all. And that's one of the main reasons why people don't necessarily get the insurance for it. We're going to talk about all of that. This is just the opening salvo here. But remember, and we'll go over this, that long-term care doesn't have to be nursing home care. And I think that's where some of this divide comes through because what percentage of people think it's very likely that they will need long-term care at some point in their lives? Only 8%. Well, that just doesn't jive, right? 70% do need it, but only 8% think they're very likely to need it. Maybe they're going off the term very likely there. Okay, maybe they're only somewhat likely to need it. Fair enough. But that's a big gap, right? And that's going to get to the heart of what we're going to talk about today, which is just making a plan. By the way, the percentage of people who have long-term care insurance, 3%, very low. And I'm going to tell you right up front, today is not going to be a day where I'm just pitching long-term care insurance to you. That is a part of the conversation, possibly, but a long-term care plan need not include long-term care insurance. Sometimes it does. We're going to talk about how that fits in potentially. But for a lot of people, not only does it not include it, it shouldn't include it, right? In terms of maximizing what you have available. So this is not going to be just a spiel for different insurance companies or anything like that. This is going to be how do I think about the questions I need to answer when it comes to getting long-term planning right. So that was our little intro. Thanks for playing along. My name is Anthony Gerbi, but most of you know me. If you by chance don't, I've been with Stein Financial Group for about 10 years now, doing a lot of these presentations and really trying to get our, I guess you could say, educational options, really covering a diverse array of topics. So we cover all sorts of things. We've done taxes this year. We've done Social Security. We've done required minimum distributions. Next month, end of July, we will be doing a market update just to talk about what's been going on in the markets for the first half of the year and where we might be going. So if you're not already, tune into our email list where you get our newsletter. We announce all of these events in advance. It's a really great place to learn things. There's always an article of the month that I'm putting in. Jeff adds in his life lessons, Jeff Stein. And it's just a great place to be. So I'll encourage you all to sign up for our email newsletter if you aren't already. Most of you probably are. The second thing I want to call out before we get started here is there is a guide, sort of a condensed Cliffs Notes version of this presentation. Really, it's like 2 pages that Aaron, I'll have you put in the chat for everybody to download if you could. It's just a PDF you can look over. It's going to go over high level keys that we're about to cover. And at the end, we are going to talk about what next steps all of you should be taking if you haven't already. And not to skip all the way to the end, but just to highlight that right now, you and I, need to be talking about your long-term care plan. We're going to talk about all the details here in just a minute. But we need to be having an individual conversation. So at the end, I'm going to prompt you to say, if we haven't talked about this recently, let's set up a time and make this the top agenda point. All right. And it's really, I don't think, an optional thing anymore because this landscape has become so complicated and there's so many decision points to make. It's a thing we need to be talking about. So when it comes to planning a safe and secure retirement, long-term care remains a confusing and unaddressed challenge to many people's financial security. Okay, I just read the slide, right? What does that really mean? Let me break this down for you in terms of what I see before we get into the nitty-gritty here. And what I tend to see when we talk about long-term care, not just long-term care insurance, but just the big picture long-term care. Um, if I were to put it very simply, the number of long-term care conversations I have is very high, right? Very high. And again, that's why I'm encouraging everybody on here. We should set up a time to have just that conversation if we haven't recently. But the number of long-term care insurance policies I work with is pretty low. And that's not necessarily a defect in the system. Again, I think a lot of people view this conversation as, well, you know, long-term care insurance, we're going to talk about the insurance in a bit, but for whatever reason, that's just not going to be the way I'm going to go. Uh, and so there really isn't much to talk about then. I've just got my money and I'll use my money as, I can to pay for care that I may or may not need, right? And that's maybe well and good. That may be our long-term care plan, but not talking about it in advance really sets us up for not the optimal experience. And I can give you a few examples of this, and I will as we go throughout. But let me get my classic long-term care story out of the way first. Some of you have probably heard this. I've told this on other presentations before, but my grandmother had long-term care insurance first off. Now, she lived till 92, and up until 92, she lived on her own. I mean, she was sharp, pretty close to all the way to the end. I mean, a little decline, but pretty good, living on her own until 92. Eventually, my this is on my dad's side, so my dad and my aunts decided she needs to go into an assisted living. She doesn't need to be in a nursing home. That'd be overkill for what she requires. And of course, if you asked my grandma, she'd be like, no, I'm definitely not going anywhere. But they coaxed her and cajoled her and got her to move into a place that was as independent as you could pretty much be. I mean, there was somebody who came and kind of knocked on the door and checked every morning, just to see, hey, need any help with anything? How's just managing everything okay? But, she really didn't even need that at this stage. We were kind of planning for the future. Well, the good news is, like I mentioned, she had long-term care insurance. And so, hey, great, no problem. She's got a few assets left. She's got long-term care insurance. Cost is not going to be an issue here. Thank goodness, right? Because that's usually what most people are worried about. However, the long-term care insurance policy she had, and this is pretty common throughout the industry, has what they call a 90-day exclusionary period on it, meaning you've got to be starting to get the care for 90 days before the benefits kick on. So it's 3-month waiting period, basically, right? Well, my grandmother had a fall and passed away on about day 87. I don't know if it was exactly day 87, but it was, she was within a week of those benefits kicking on, had a fall, passed away, and never collected a dime from her long-term care insurance policy. And you probably are thinking, isn't that kind of the worst case scenario, Anthony? You paid all these years, or she paid all those years for that insurance and never collected a dime. And I can't necessarily argue that's kind of what you hope doesn't happen, but I still advocate that we talk about long-term care insurance, even though that's a personal story I have. And that should tell you something, right? That should tell you it's not that I'm so irrationally opposed to it because I had the worst case scenario happen in my family. Long-term care insurance is a tool. And it is something we'll talk about. And some of you may have even seen there was an article in the Star Tribune recently talking about sort of the downsides of long-term care, not in terms of what they cover, but in terms of all the pitfalls you can fall into, things they don't cover, times they fight with you, right? All that we'll kind of get into, and we can even get into that article a little bit. But there are three main reasons, with a fourth bonus reason, why people don't get long-term care insurance. And again, I promise it's not going to be all about insurance. But just at the top, so you can kind of flag these as I go through and we'll talk about them. The kind of the holy trinity of reasons are long-term care insurance is expensive, it's hard to get, and you might not use it. Those are the three reasons why people really balk at it. It's expensive, it's hard to get, and you might not even use it. Now, all insurance, you kind of hope you don't have to use it, right? That means something bad didn't happen. So I get that. That's true of all insurance, though. But expensive and hard to get, that's a bad double whammy, right? Not only do I have to kind of bend over backwards to try to get it, or I have to be healthy enough to get it. Not, you don't have to do anything strange to apply for it. But then I get the privilege of being healthy enough to write a sizable check to an insurance company every year for something I might not ever use. And let me tell you the fourth bonus reason before we move on. The bonus reason, as the Star Tribune article recently kind of laid out, is sometimes the insurance company fights with you over the benefits that you thought they were supposed to pay, and they're arguing they don't have to pay. And that's an even worse scenario, right? It's not just that, well, you paid all these premiums, you had it for years, you were prepared, something happened, you're ready, you apply the insurance, and all of a sudden they won't pay. That's really turns people off, as it should, right? And we're going to talk about that in more detail. Again, I'm teasing, I'm kind of queuing things up here. But even with all that, not besides it, but even with all of that, it's still a piece that we need to consider. So let me back off the insurance conversation because, again, that's not what this is all about. Let's talk about, in general, planning for long-term care. And we're going to define long-term care too. So why are people not planning? Go back to that quiz that I just had up on the screen. What are the reasons why 70% of people may need it, but only 8% of people think they'll need it, and only 3% of people are actually potentially planning for it? Well, one, if you're younger, it seems remote or far off. Hey, I've got time to plan for that. That may be true, but eventually time keeps moving at the same rate, right? And if every day we don't plan is every day without a plan. A false sense of security. Hey, and ironically, you'd think the people with the false sense of security are, hey, my parents both lived to their mid to late 90s. They were sharp up until the end. They were best case scenario. I feel good about my odds. I get some people like that. The majority of people who have this false sense of security, though, are on the other end. Hey, nobody in my family has ever lived past 75. What are the odds I'm going to need long-term care? My clock's ticking here. And I would say, don't be surprised if you live longer than you think you do. I've used this stat 1,000 times, but for a couple that is both over or at age 65, there's a 50-50 shot statistically, one of you's making it to 90. And a 50-50 shot, that includes everybody. That includes people who already have conditions that might shorten their lifespan. That includes people with really high risk factors. The classic example is, well, life expectancy factors in people who smoke, right? Well, technically, those people tend to have lower expectancies because of the effects of smoking, but those statistics still factor them in. So there's a good shot you're living to 90, or one of the two is living to 90. We better plan for that, is my point. You don't want to think about it. I won't just read all of these, but there's a lot of different reasons why this gets pushed off. And again, it has to do with insurance, but just has to do with planning as well. So how do we think about that? And what are the things we're actually doing when we're planning for long-term care? Well, if you've had to clean up for a parent at some point, think about what that entailed and how we can streamline that for your family, right? Emotional risks, family strife about responsibility. If you don't have a long-term care plan, or if your plan is just, well, my family will pick up the pieces, think about that. Have you ever seen an 85-year-old woman taking care of an 87-year-old man? That takes a toll on people. Those of you who have maybe done that for a family member know that better than anybody. Caring for someone in home is taxing mentally on the caregiver. And they may be doing a great job in really creating a good quality of life for the person receiving the care, but they may need a break at some point. And if there's no long-term care plan, who's gonna come in relief for that break? If there's no plan for hiring someone to come in a couple days a week or every day of the week, that caregiver is going to be stretched thinner and thinner and thinner and thinner. And this is just one example, but this is why this conversation is so important. You can read the other things here. There's, of course, other emotional costs. Putting yourself, there are some people who will tell you, whatever happens, I just don't want to be in a nursing home. And this is kind of a funny statement. It's not fun, haha, funny, but I find that this statement is becoming a little less common. And this is just my pet theory about it. But my pet theory is this was a very common statement in the, not the baby boomer generation, but one generation prior, the greatest generation, right? I'm not going into a nursing home. And then all the baby boomers had to care for their parent who didn't want to go into a nursing home and had such a rough time doing it because of all of these emotional and financial stresses that it causes, and said to their kids, you know what, kids, just stick me in a home when I need to be. I don't want to be a burden to anybody. And some of you may be saying, no, I definitely don't want to go into a nursing home. That's fine. Whatever you want is what we're aiming at. But I always smile when I see this because I think this idea is becoming less and less common. So there are going to be four keys we're going to go over. I'll sum them up at the end, but here's number one. Long-term care isn't, again, is the key word, isn't about an elderly person sitting alone in a nursing home. It's a range of services designed to help people with health and personal care needs. Okay, that's a very stuffy way of saying, and this is, if you've got a pen and paper, I'd write this down. Long-term care does not equal nursing home care. It can, and that's the highest end of it. But long-term care is a spectrum. And that spectrum on the lowest end can be stay in your home, live an independent life. It doesn't have to be full-on nursing care, whether in-home, assisted living, nursing home. We're going to talk about all that. But it can be in-home care. And again, if that's a really important goal to you, if you are a person who says, don't put me in a keep me out of a nursing home. I want to stay away from that as long as I possibly can. Like my grandmother said, then this is vital. This is incredibly important that we plan for this. So what is long-term care? Maybe this is the first slide that should have been in here, but I think we needed to set a few things up first. Long-term care, as an insurance company defines it, which is really what we care about because that's usually when benefits start getting paid, or Medicaid. Medicaid would define it like this too, and we're going to talk about Medicaid, is when you can no longer do two of the 6 activities of daily living. All right. You may have heard about those before. Here's what they are: bathing, dressing, eating, transferring, toileting, or incontinence. Right. So, by the way, difference between toileting and incontinence, I get that question. Toileting is just getting to the bathroom, and sitting down, basically. Incontinence is just I can't even get to the bathroom, right? I need more help than that. So those two things sound similar, but there is a distinction there. So anyway, this can be something that you need permanent help with. Every time I bathe, I need someone there to help me because I just can't do it. Or it could be something you only need intermittent help with. Hey, I'm okay a lot of the time, but I just need somebody there once a week to just make sure I'm getting all the other things done. Again, every situation is different, but again, don't think of it in terms of I'm totally debilitated before I qualify for long-term care. Again, you don't have to be. It could be hands-on versus standby care. And I bring this up just to show you again, for insurance companies, they care if you can't do 2 of these. It doesn't have to be you can't do all of them. It can be, hey, I've just got some trouble with 2 of these different things, right? So that's an important thing to talk about. Again, this just goes back to that first quiz we did. Only 8% of people think they will need long-term care, but 70% of people actually do. And why is that gap so wide? Well, now we have a little bit more context. It's because long-term care covers a lot of different things. It's not just nursing home. And I think that's what people think about first because it's the most dramatic example. I get it. But long-term care can happen in a lot of different places. It can happen at home. It can happen in a retirement or independent living community, right? It can happen in an assisted living community, or you're in a building but you have your own apartment. Somebody, you maybe go for communal meals, there's group activities, somebody checks on you once a day, maybe you're getting some sort of medical care or rehab while you're there. All that stuff's in-house versus a community where you may still have to go outside of a house or apartment or townhome that you own. And then obviously a nursing home is the far end of the spectrum where it's a more intense assisted living. I think most of us probably know what nursing homes are. I don't need to spend a ton of time on that. So, what are the costs? That's what a lot of people ask. Well, okay, if I'm not going to get insurance and I am going to try to pay for this out of pocket, what am I going to pay? And let me move over here so I can go through this left to right. So, first off, the left 300,000, let me read that. That is not what long-term care costs. That is the estimated medical care costs in retirement for a couple. So I'm talking all the years of your retirement, your medical needs are around 300,000. Again, very average number. Some people are going to be more than that. Some people are going to be less than that. Just it's a baseline number. That's before long-term care costs. That's just medical costs. All right. Now, the national median for one person for long-term care per year. Now, again, there's a wide range here because the level of care can vary so wildly. But the median, and by the way, the median is just, if you're not familiar, median means half of the data is above that line and half is below. So it's like an average, but slightly different. Anyway, it ranges from $50,000 to $100,000 per year. That's spendy, right? Now on the low end, that means the median's 50. Now you may be somebody who only needs to pay 20,000 per year, right? You may need a low level of care. Okay, then you're lower than average. That's good. You're paying less. But in a metro area, and this presentation talks about New York City, Minneapolis is not going to be as expensive as New York City, but it is going to be more expensive than the national average or the national median, I should say. And now we're looking at 70 to 155. Now that 155 on the high end, don't get freaked out about that. That is the highest possible level of care. I mean, we're talking memory care. We're talking this person is totally out of it and they are needing 24/7 care for the most part. That's where you get to those really high numbers. And that does happen. I'm not trying to say that, well, just throw that number off to the side because who does that really affect? No, it happens. But don't assume that that's going to be you from the get-go, right? You know your health better than we do. That's going to be a lot of the idea when we have this conversation is you know your health. Tell me what you're thinking about for this, and we'll try to find a way to make it work. Will Medicare cover any of the costs? First off, not a great plan to count on Medicare. And Medicaid does kick in. I'll get to that in a second. But a plan needs to be a little bit more encompassing than just those. So this is key number 2. I'd write this down. Medicare is not going to cover the cost of your long-term care. Pretty much, period. They will cover some short-term care. Let me get to that. That's going to be on one of the next pages here. Medicare will cover short-term care. And one of the keys here is that Medicare will kick in if the assessment has been made that you are recovering from something and you will regain full capacity, basically. So I fell and I broke my hip, for example. I'm expected to make a full recovery. This isn't going to be something that forces me to live in a nursing home for the rest of my life. I just got to recover. Okay, Medicare probably pays for that, again, depending on circumstances. But hey, I've got a chronic illness, a debilitating illness. I'm not going to recover. I'm just trying to manage it. That's not something Medicare is going to necessarily cover, at least in terms of your living arrangements. So that's where, again, the long-term care planning that we do, that's what's going to pay for it. Again, it could be insurance. It could be out of pocket. It could be a combination of both. It could be Medicaid at some point covering some of that. But that's not going to be covered by Medicare. So don't have this false sense of security that, well, whatever, I can't pay for out of pocket, Medicare is going to pick up. Depending on what it is, possibly not very much at all. Medicaid then, and by the way, Medicare versus Medicaid. Medicare is what we all sign up for at 65. That's just senior health care. Medicaid is low income health care. And basically, Medicaid kicks on when we've exhausted all of our other assets. that may or may not be a good plan to try to exhaust assets, right? Because of different family circumstances, your goals. I'll get into that here in a second. Medicaid covers long-term care for eligible low-income adults. However, you have to use up your assets first. And I believe at this point, for income sake, or excuse me, for asset sake, you need to show, assets of single digits, basically. Not $5, but like $2,000, I believe is the limit right now. And that may change or may not. And they may change these rules at some point, but basically you got to be down to nothing. Now, a lot of people on this call, you're going to have Social Security and you're going to have pensions totally. Those are going to be eaten up in your care costs before Medicaid kicks in, right? But you get those every year. So those are not what we would call an exhaustible asset. But I'm talking about exhaustible assets. I'm talking about deferred comp accounts, 401ks, IRAs, your house, any other investments you have. They're going to want that stuff in large part. And there are some exceptions for spouses where they can keep some of it. But they being Medicaid, before they kick on benefits, are going to want that stuff to be mostly exhausted. It's spent, I guess, in other words. Exhausted maybe is a real jargony term, but they're going to want it to be spent. And that's because this is a government benefit for low income. It is valid to say, look, I'm going to pay for my long-term care out of my assets. And if I deplete my assets, Medicare is going to be there to Medicaid, excuse me, is going to be there to pick up the slack. That is valid, and that could be our plan, but it better be a plan we're going into with eyes open. Because another part of a Medicaid surprise is, you probably have heard about this. This is one of those popular things that goes around if you're part of a coffee group or if you go to a dinner party or whatever. You'll hear somebody say this: hey, my uncle was super smart. He transferred the family cabin to my nephew. And then when he went into the nursing home, they couldn't make him sell it because it wasn't his property anymore. That technically true, you can do that, but what a lot of people don't know, and this would be a nasty surprise to get caught by, is Medicaid looks back 5 years at what you did own. And if you transferred something within the past 5 years to somebody else, an asset, they might make you liquidate that asset to pay for your care, basically to not let you circumvent their policies. So don't get, I have people who ask me about that from time to time. Hey, I heard about this. I heard about this. There are ways to do it that may be a part of a long-term care plan, but it's more complicated than the person you probably heard about it from really probably told you, is what I've found, right? People say, hey, I heard about this. Isn't this really smart? It's like, well, it could be, but it's more complicated. By the way, it also changes if you're doing this with property. It changes tax status for the person who's inheriting it or being transferred it. There's a lot more moving pieces than what it sounds like in those quick stories they tell you about how smart I was. And I think that's the thing that catches people off guard. It's not a slam dunk that everybody should do that. And that's what the people who do it kind of make it sound like. No room at the inn. All right. So when Medicaid kicks on, if that's what ends up happening, yeah, you might have your care paid for, but you may not have the same standard of care paid for, meaning you may not have the nice apartment that you used to have. You may go down to a much smaller room. You might share a room. You might be forced to move. You might be forced to move facilities, right? They're going to pay for you out of a Medicaid bed, which is a lower cost usually. So that's one thing to really keep in mind as we potentially build Medicaid into a plan. Well, we've got to be sure that we've got a reasonable expectation that you're going to get good enough care, or at least care that you're happy with, if we do have to go on Medicaid benefits at some point. And again, a lot of this is an if. Most people on here probably won't go on Medicaid benefits. I feel confident in saying that. Some of you may, and that may be a good thing. That may be part of our plan. But again, this is why it's so important to plan. Because if you're forced to do this, there's a lot of surprises, as I'm getting into, that could really catch you off guard, I guess is what I'll say. So additional risks, strained healthcare system, what's Medicaid going to be in the future is always a question, just like Medicare. I'm not necessarily super worried about them just pulling the rug out from under us and saying, now, Medicaid, we're done. But if you're relying on a government system, a government that is increasingly going into debt, uh, where we're continually having arguments about where revenue is going to come from. By the way, Medicaid is run by the states. So it could make a big difference if you're retiring in Minnesota versus Florida versus Texas versus anywhere else. A state is going to have a lot of variability there. Medicare is federal. So now we're talking about the federal government, but Medicaid is run by the states. And then finally, paying out of your own pocket. Now, paying out of your own pocket, again, might not be a bad thing. We just got to be prepared for it if that's our plan. And it makes, I can't tell you enough. I mean, again, I've been hammering this quite a bit, but let me just say it again. I can't tell you enough how big a difference emotionally it makes to just know where the money's going to come from. I don't care if what you ended up doing was the same thing you would have done if you all just did this spur of the moment, I should say. Meaning, hey, let's use two scenarios as an example. One person comes in, talks with me, we sit down, we make a plan. Okay, if healthcare needs arise, this is where we're going to pay for it from. Great. This is our plan. Versus the person who never talks to me, the healthcare needs arise and says, well, I'm going to pay for it out of this account and then that account and then that account. Even if those two people pay the exact same way, if they're carbon copies of each other, the emotional life of the person who had the plan in advance is, again, I can't speak for everybody, but in my experience, vastly superior. You're dealing with way less stress, even if you pay for it the same way, just by talking about it ahead of time. So that may be the real take home point from this whole thing, just in a nutshell. Talking about it ahead of time, it's not about even necessarily saving money because your healthcare is your healthcare. So you need what you need. But it's about knowing what our next step is and not sitting up at night saying, how am I going to deal with this? We've thought about it in advance. We're good to go. That's my whole point about this. So, long-term care insurance. I've heard long-term care insurance isn't a good deal at all. So, are there really any options? Okay, so this is where I could bring up that Star Tribune article. Again, if you don't know what I'm talking about, you could Google it. I'll kind of summarize it here. Not the whole thing, but just very quickly. There was a Star Tribune article very recently I got asked about a couple times that was talking about long-term care and how difficult some people were finding it to even get the benefits that they had been promised or that the policy had laid out. And that is true. Although some of the stuff in the article was a little bit, there were a little bit more context was needed. Like sometimes they made the case that, well, the insurance company didn't want to pay out for 90 days. It's like, well, I guess that's technically true, but that's that exclusionary period. I talked with about my grandmother that I mentioned in that story. That's pretty standard. So it's not like the insurance company was trying to yank your chain there. It was just that's built into the policy. But there are examples where you go into a facility and you need care and an insurance company might fight with you. So isn't that just another reason, Anthony, not to do this? Well, it could be. And what I'd tell you is the fact that insurance companies are potentially fighting about this shows you how valuable the coverage is. So maybe that's a point in the, well, maybe this is something I ought to work out. But I guess let me put it this way. Long-term care insurance. I think there's even a slide that just mentions this. Yeah. Here's key number 3. Let me give you the context here. So long-term care insurance, when it first came out, the insurance companies screwed up. They did not price long-term care insurance right for how much they were going to have to pay out in the future. So it was a great deal for people who bought in a long time ago. They may not have realized it at the time, but the insurance company screwed up. I always think back to, so I was, when I was in college, I took my degrees in economics and I took a few fairly advanced economics classes. And I had in one of those classes, this is small class size for the University of Minnesota, probably 30 of us. And it was in a game theory class, which I won't go into the details of because it'd bore you. But there was a guy I worked with. We did group projects together named Max. Max was incredibly smart, one of the smartest people I came across in my whole time in college. And we did group projects together. So I got to see right up front how good he was. He was good at math. He was good at, not just calculations, but the reasoning behind them, everything. Max, while in school, as we were talking, was taking actuarial tests, which, if you know anything about being an actuary, that's who insurance companies hire to do all the math for this stuff. You got to be pretty smart to be an actuary. And the tests to become one, to be licensed and get approved there, basically, are known to be incredibly difficult. Well, he's doing this while he's doing his schoolwork. So, again, really bright guy. And I think about Max today working for an insurance company, and they're the ones, the Maxes of the world, are in charge of getting these things priced correctly, these insurance policies, making sure that the premiums the insurance companies are bringing in are enough when spread out over many, many people to pay out the benefits that they promised. And what I can say is the actuaries of the 80s and 90s did not get it right mathematically. They did not expect people to live as long as they did. They did not expect healthcare costs to be as expensive as they ended up becoming. And that led to a couple things. One, if you have long-term care insurance right now, you probably get a letter every year that says, hey, or not, maybe not every year, but a lot of years, hey, your premium's going up. I get asked about these letters all the time. Hey, we're going to increase your premium. By the way, they can only increase your premium if they increase everybody's premium. So that's the situation. It's not that they're picking on you, but it's still an increase. And I get people ask me, should I do it? Because in the fine print, under them saying, hey, your premium's going to go up on your insurance policy this year, they'll say, hey, if you don't want your premium to go up, no problem. Let's just drop your benefits down a little bit, just a little bit. And we'll do that this year, and you'll keep your premium the same. Or, hey, I've got a great idea. Do you want an even lower premium? No problem. Let's cut your benefits even a little bit deeper. And you might not even use this anyway. So what's a cut to you is kind of what they're tempting you to think. They don't explicitly say that. And the thing I always say to people is, look, we should absolutely consider whether it's a good deal to cut your premium by reducing benefits. I'm not saying we just dismiss that out of hand. But the insurance company, with people like Max running it, would not be offering those cuts to you if they were not in the insurance company's best interest or what the insurance company thought it was its best interest. Meaning, in other words, probably you don't want to cut your benefits because the benefits that they're offering you, they probably have now realized are too good. And that's one of the reasons why long-term care insurance policies can be attractive, is because the insurance companies, you kind of get into their pocket if you end up using them. And that's kind of what you want. You hope to never use an insurance policy like that. But if you do, it's nice to get into their pocket. And that's what the insurance companies screwed up. That's why they have this history of fighting with people, because they're fighting over every penny. I always say about insurance companies, they're not doing this out of the goodness of their heart, right? They're doing it to make money. So they're raising premiums. They might refuse to qualify. Now, that's fewer and further between than I think like the article I mentioned would have you believe, but it does happen. I'm not trying to minimize it. It's hard to get long-term care insurance. You have to be relatively healthy to get it. They've started excluding people that are, quote unquote, unhealthy or have a condition that they would say disqualifies you. And you got to pay a premium every year. And believe you me, you're going to write that check every year and you're going to kind of wince a little bit, because you're going to be like, what if I don't use this? What if I'm just throwing a few $1,000s a year down the drain for something that never ends up happening? And, to an extent, that's sort of the game we all play with insurance. But I will tell you, again, one of the biggest reasons to consider it is because you do get into the insurance company's pocket if you use it. So not again, it's not right for everybody. I'll say that right up front. Not everybody needs long-term care insurance. But with some regulatory reform that we've had, it's actually a little bit clearer now what it does and doesn't cover. I've got some people I work with who have older policies who have lifetime benefit payouts, meaning you go into a nursing home or you start getting assisted living, you get X amount of dollars, whatever their policy covers per day for the rest of your life. That is an incredibly good policy if you have it. They don't sell those anymore. Now there's time windows on them. Well, it covers you for 3 years, covers you for 5 years, covers you for 7 years. Your inflation factor is 5%, 3, whatever. We can, we deal with all those details individually. But it's a little bit clearer from the get-go. Again, I'll highlight this bullet point, all up front underwriting. It's a little bit clearer what you're signing up for these days. They don't require you to be in the hospital. They don't require you to get skilled nursing, quote unquote. You may qualify to use your long-term care insurance benefit, even if you're just getting care from a family member. A lot of people don't realize that if you qualify, you could get a family member paid out of your insurance policy for taking care of you. Again, you have to qualify for it, but that's possible. So there's a lot of different things that have improved. And in response to those improvements, the price has gotten higher and it's gotten harder to get. That would be what I'd say. So it's absolutely legacy. Let me say this before I move on here. Original policy. So, if you got your long-term care policy 20, 30 years ago, without the protections that were just mentioned on this previous slide, are still causing problems, meaning insurance companies maybe have more leeway to fight with you over benefits. They potentially might be able to cancel a policy. I'm not trying to get salacious here, but those are things we need to think about if you do have an older policy. What is the latitude for the insurance company to yank our chain around on this? That's something we should be thinking about. So long term, let me wrap that up real quick because we're going to kind of get into a summation here. And then there will be time for questions. By the way, I didn't mention this at the start. Anybody who has questions, feel free to type them in the chat or the Q&A feature on Zoom. Certainly, you could email or call us about them afterward, too, if it's something that's really specific to you. I mean, you'd rather just do one-on-one. Great. Again, I'm going to encourage everybody. We should set up a one-on-one anyway. But let me wrap up long-term care insurance. Long-term care insurance is an incredibly powerful tool to help pay for healthcare expenses in retirement. Let me give you an example that I don't think a lot of people think of, but can be a really powerful way to do it. And this is based off real life that we've worked with. Um, if it's a couple, a married couple, let's say, and so most of the assets, if not all of the assets of that couple are joint, whether they're joint accounts but you think of it as one big pile, not two separate piles, right? If that's the case, and especially if there's a large age gap in between the two. So I'll give you a real world example. Had a married couple, just like I described, and there was about a 10-year age gap. The husband was about 10 years older than the wife in this case. Would it make sense not to get long-term care insurance on both spouses, but on the older of the two, especially if the older of the two is male? And I bring male into it because men don't live as long as women, which means that not only is he older, so his healthcare events are likely to happen sooner than the wife's in this case, but also he's just a male, so they tend to happen sooner anyway, just based off of statistics. So where I'm going with this is why not look at a long-term care insurance policy for one? Because what's the real danger? What are we trying to insure against? Well, if in this case the husband, I'll use this real world example, were to need long-term care, he's older, so maybe he experiences a chronic illness, whatever. Something happens, his healthcare takes a turn, he needs more advanced care. What is the risk? Well, the first risk that everybody thinks about is, well, how is he going to pay for his care, right? That's what we're talking about. But there's a second risk that we need to think about. What if in paying for his care, they deplete all of the joint assets of the household, meaning the wife has to move into assisted living with him because they have to sell their house in order to pay for their care? What if they deplete all of their retirement accounts that the wife needs for another 10, 20 years after the husband potentially is gone, just because of her life expectancy being a lot longer than his? That's a real risk. So it's not even that they don't have money to pay for care. It's that in paying for care, they're going to deplete the assets of the spouse who does live longer. That could be, and in this case, this is what they did. They took out a long-term care insurance policy on the older, in this case, the husband, specifically because of that risk. They looked at the price, they did qualify for it, but they said, wow, this is really expensive, Anthony, if we both get this. And I was like, I have to agree, it is pretty expensive. Have you considered going this way, getting it on only one of you? And they said, oh, that might be a good middle ground here. And that's what they ended up doing. So again, it doesn't have to be exactly that scenario, but think about that. If there's two people and we're worried that the care for one might deplete the assets for the other who's going to live longer, It's something to think about whether you should be doing this or not. Okay. New approaches to planning for long-term care address people's skepticism and provide a wide range of flexible options. Okay, that's a key. Basically, what this is trying to tell you has been my thesis all the way through, being you don't necessarily need long-term care insurance, but we do need to think about your long-term care plan. How can you build a long-term care plan? Well, you could get insurance. That's the classic way. There are investments out there, annuities, and annuities are their whole world. And I always say, if you've ever talked to me about annuities before, I say, you do the right annuity is the right tool for the right job. And if it's not the right tool for the right job, it's not right for you because you can get into deep water with annuities quickly. But they sometimes offer long-term care benefits. Let me give you an example for people who are uninsurable, and we've had scenarios like this because you've got some sort of condition that the insurance companies are like, yep, we're not going to write you. Okay. If you've got assets, we could invest in one of these annuity accounts. And what the insurance company then says is, okay, this is an investment, this is an asset. It'll grow, hopefully. That's the goal. So let's say we stick in $100,000, and I'm just picking that because it's a round number. If you use this money for your living expenses and everything goes fine, you don't need long-term care, great. It's going to be worth 100,000 plus whatever growth we get in here. And it depends on how you invest it. But they may offer you a kicker if you use it for long-term care expenses. And what I mean by that is if you can prove to them that you can't do two of the six daily activities of daily living that we covered earlier, they may say, hey, in terms of what you can take out of this account now, we're going to give you a multiplier. We're going to say instead of the 100,000 you put in, we're going to let you take out up to 200,000. We're going to give you a double multiplier. And it all depends on where rates are, but that's in general how it works. And that can be a really attractive option for somebody who's uninsurable or just doesn't want to pay premiums. And you may want to split the difference between, well, if I buy insurance and I don't use it, I just lost all my premiums for all those years. Sunk costs, I lost them. If I go this other route where I buy an investment that gives me this multiple, I get kind of the best of both worlds potentially, right? I get to keep the money still mine. I'm not giving it away or paying for something. It's my money, it's invested. But then if I do need it for this, I've got a little bit better benefit than if it was just sitting in cash or in a regular investment account. So that's a scenario that it's up to somebody like me to bring up to you as we talk about this. Again, you don't have to become experts on this. You just need to know who to ask the questions to, or just who to talk to, and I'll ask you the right questions. And then finally, there's other strategies too. Healthcare savings accounts can be used to pay for long-term care. Sometimes people like to save those because they're like, well, if I do go into a nursing home, this is a great way to pay for it because it's all tax-free then. Some people like to use their health savings accounts right away. There's pros and cons to both approaches, but that's something we can talk about. The other piece that I want to bring up is for those of you who have the 1% Hennepin County supplemental account. All right. And if what I just said sounded like gibberish to you, then you probably don't have it. So I'll keep this brief for those people because this doesn't apply to you then. But if that does sound familiar and you do have that 1% supplemental account, that could be a great source of long-term care funding. And the reason for it is I hope I've brought this up to you before. That account, when you take the first dollar out of it, you've got to have it empty within 5 years, right? So even no matter what your balance is, it's got to be empty. Well, that sort of lends itself to what's a big cost that's going to happen over the course of a handful of years that I'd be okay with spending this on. Kind of long-term care fits that bill the best. So for a lot of people, if you do have that account, that's a great one to earmark for this, to say that's my long-term care insurance policy, that account, and great. Then I've got a store of assets that I've already earmarked for that. So, and again, if that didn't apply to you, thank you for indulging me. For the people who it did, I can certainly give you more info if you're like, are you sure I don't have this, or what does that mean? I can give you more info. Equity in your home is another way, and not just through selling your house, but if you've heard of a reverse mortgage. Some people do reverse mortgages where basically what you do is you have the bank start sending you checks per month and they're gradually buying your home from you. Literally reverse mortgage. You're getting paid by the bank gradually to then they'll own your house. But it's income to you, and you get to keep living in your house. That's the key. Because if you're moving into a facility, you might say, well, why wouldn't I just sell the house and take all the cash up front? Well, you probably would. But if you're dead set on staying in your house, a reverse mortgage could be a good way to accomplish that. I already mentioned HSAs. Roth IRAs is mentioned here because Roth IRAs, you never have to take money out, and a Roth IRA allows the money to grow tax-free. That can be attractive for expenses that may happen later in life because, again, that's when long-term care expenses are more than likely to happen. But again, it's a case-by-case basis. This is where the customization really comes in. I just talked about a reverse mortgage. It is what it sounds like. The bank pays you money. Eventually, the bank owns your house. It can be attractive for tax reasons, but really the reason most people do it, I want to stay in my house, but I need more money than what my investments maybe can provide me, or I've exhausted my investments. Where am I going to get the extra cash from? Well, that's maybe a place to do it. Existing life insurance policies that do not have long-term care benefits, you may be able to accelerate a life insurance policy that you already have in the case of a high need for long-term care. Again, it depends on the policy. I don't want to get way into the weeds on that, but that's another thing we would consider as we talked about what your assets are and what our options are. Finally, our investments, of course, are probably a way that most of us are going to pay for at least some of our care if we end up needing it. And that's totally fine. That's what they're there for. Yes, they're there for all the stuff before that too. And I want you to spend your assets on things that are important to you. But it's also nice to have a cushion for what if my healthcare is more expensive than I thought? That's part of any long-term care plan. So I don't want to make you think that, well, I've got my assets, but that's pile A over here, and pile B is where I need to take my healthcare money from. No, it's all one pile. We just need to be smart about it. Health savings accounts, I already mentioned. It's a great way to do it. A lot of people don't keep their health savings accounts all the way till, their 80s or 90s or when they might need this care. They kind of use it sooner. There's pros and cons to that. A lot of people like using it sooner because it's like, well, I'd rather take the benefit of it now. While I know I'm still around, I don't know if I'm going to live till 80 or 90, and I might as well use it while I can. That's often a good strategy, but we can talk about pros and cons there, and it really depends on how the rest of your picture looks. And what about simply self-funding? This is the way most people are going to go about paying for long-term care insurance. They're going to pay for it out of pocket, or excuse me, not long-term care insurance. I misspoke. Just long-term care expenses. You're going to pay for it out of pocket. You maybe have Social Security and a pension. That may cover a lot of what your expenses are. And remember, a lot of people forget this. If you do go into an assisted living or even a nursing home, remember that's where you're living. So I'm not saying you have to go out and sell your house immediately, but your house may be an asset at that point. You may turn that, because a lot of people say, well, I look at my account balances and I'm like, how am I going to pay for long-term care with these account balances? Is that going to last me long enough? And it's like, well, maybe on their own, they might not last long enough. But remember, your house might come into that equation at some point too. And people say, oh, I forgot. Yeah, I can only live one place at a time. If I'm living in a assisted living place, I'm not living at home anymore. So that's now an asset for me. Again, it doesn't mean you have to sell it. We talked about reverse mortgages, all that sort of stuff. But what should you consider? This is really the last point. Then I'll open it up for questions and wrap up here. But when I look at your situation, right? And again, you don't need to even necessarily worry about this. You just need to know somebody who does know how to think about this, which is right here. But what's your age? Are you married or not? What's your health like? Where do you live? People overlook that one so much. And I don't even just mean what state you live in. I mean where? Metro, outstate. There's different challenges, right? If you live in the Twin Cities area, your cost of care is going to be high because it's a metro area. If you live outstate Minnesota, and I'm using Minnesota as an example, but this is generally true of other states too. If you live outstate, your problem might not be cost, it might be location. Am I going to have to move 30 minutes up the road just to get into a place that can satisfy my requirements? Well, I got to think about that, right? So, and that's true of the urban-rural divide in any state you might live in. Military service, I have not talked about that once, but if you have military service, there's VA benefits that could potentially help with this. So that's a huge thing that we need to talk about. Family history, I think, really goes in that the health sort of the equation, but it's also just Um, if you have, if you don't have people in place who are going to sort of help you navigate this, it's even more important to do it up front yourself. And what I mean by that is, if, let's say you don't have kids, and or your kids just are not in a place where they're going to be able to navigate this and help you with it, you got to have a plan up front. You just gotta, because if you don't have somebody you can depend on to help you make those decisions, then you better make them in advance, is what I'm saying there. Certainly, what your assets, what your financial planning says about this, what your legacy plans are. Did you want to leave money somewhere? Okay, well, then we need to earmark that. But it's also important to say who's going to provide the care? A family member, a friend, a professional? Where do you want the care? In your house, a retirement community, an assisted living, a nursing home? And how will you pay for it? Those are the three obvious questions. But what we just spent an hour looking at was all the ways to think about those three questions and what you're really asking when you get to it. Everyone's situation is unique. You can receive care at home. And when it comes to a safe and secure retirement, planning for long term care, it remains confusing. Don't get me wrong. But if you keep in mind these four keys, and again, that document Aaron shared goes through these four keys, so it's a great just kind of take home point. It's not about an elderly person sitting in a nursing home. It's a range of services. And that's why people underestimate whether they'll need it or not. You may not need it, but it might be great to have it, I guess would be the point. A long term care plan that allows you to stay in your house, for example. Counting on Medicare or Medicaid by itself is not a good plan. In tandem with something else, Medicaid can be a part of a good plan. Medicare probably not going to cover much at all. Given historic problems with long-term care insurance, it's understandable that you may balk at that, or you may decide you don't need it. That's totally fair. We still need to ask the question. That's why I go back to that story with my grandmother. And finally, there's new approaches. There's different things we can do than what we could do 20 or 30 years ago with your existing assets to set up a plan that works for you, involving or not involving actual long-term care insurance. So you need a custom approach. And what we need to do is set up a time to talk about this. Now, we may have already done that. You know, I know some people on this call, we have had this conversation before. That doesn't mean we can't have it again. That doesn't mean we can't rehash it and go through from the very beginning and say, is there anything we could do better? Totally. That's my job to do. But if we haven't had this conversation, or you're somebody who hasn't worked with us before, I would really encourage you to set this up. It's just set up a time on my calendar. Aaron, if you would put a link to our bookings page in the chat, you can certainly find it on our website too, steinfinancialgroup.com. Or you can just send an email to me or to Margie, or, you know, there's a million ways to get in touch with us. I would really encourage you. We'll just talk about this. Say, hey, what's our plan? What are your assets? What are your needs? What are your plans? All those different 8 different questions we had. We'll go through all of that. And I would really encourage you, if you haven't, to do that. Okay, we've reached the end. I started 1 minute late and we're just over 1 o'clock. So I really appreciate everybody being here. Here's contact info. I will be around just for a couple more minutes to answer questions. If anybody has them, please stick them in the chat. But if you don't, or if you want to send me a separate email, again, contact info is right there on the screen. And if you don't have any questions, I hope you have a great rest of your day. Come back next month. We're going to be talking about a market update, which is always one of our more popular ones. Everybody wants to know where the market's going. I promise we'll bring out the crystal ball. Okay. I can't promise that. We don't have a crystal ball. That was a joke for clarity's sake. I have to say that was a joke. How do you get long-term care insurance if you're older? Great question. And the answer is, it doesn't necessarily depend on your age. I mean, there are certain policies that they will not write over certain ages, but in general, it depends more on your health than your age. Obviously, those two things tend to be correlated, but you can apply for long-term care insurance if you're older. You don't have to be in your 40s or 50s, although sometimes younger is the better time to get it, because the older you are, the higher your premium is going to be. That's really the big barrier. So if you qualify, if you are healthy, being older usually just means you're going to have a higher monthly premium, because the insurance company, again, going back to my college friend Max, is they're calculating how long they think you're going to live. And they're basing what they're going to charge you off of how soon they think they might have to pay benefits. And that's usually the issue. So if you are interested, I can get you some quotes and we can see if you qualify. But there's not necessarily a barrier because of age. It just gets harder and more expensive because of age. So you get it just like you'd get it as a 40-year-old. It just depends on your circumstances whether you qualify or not. Um, Heard from someone that if you have more than one long-term care policy, there may be a conflict as which one will pay. Yes, that is possible. It totally depends on what the policies say. But if you do have more than, let's just say, again, I'm oversimplifying here, but let's say they basically read word for word almost the same, and one pays you $200 a day for 3 years, and the other one pays you $250 a day for 3 years. Depending on how those are written and how the benefits are applied, and this is where we'd have to go into their specific situation specifically, but depending on that stuff, it could be that the insurance companies would fight with each other over who actually had to cut the check first. And if it covered all the needs, then the other one would say, well, we don't have to pay out the rest of it. So depending on the policy, it might not just be, well, I've got two policies. So now instead of 250 a day, I've set myself up for 500 a day. Aren't I smart? That doesn't always work like that. So what you heard, I totally believe. It totally depends on their policies, though. I'm not saying it's impossible to get two policies that would pay, would each pay out in full. My gut, though, would be it would be better to just get one policy that paid out double the amount, because then you don't have to have these insurance companies fighting with each other over who's going to pay what and maybe delaying your own benefits. So I usually, in fact, I can't remember a time where I've recommended somebody get two long-term care insurance policies. The only situation where I could think right now that it would be smart is if you had a legacy one that really only covered a very narrow set of things. I might say, well, it's probably still good to keep that one, but let's get one that covers more, is wider, and hopefully we don't allow for any of those conflicts there. So totally possible, but it would be fraught with potential pitfalls to get two policies that were very similar, is what I'll say. Um, so if you would like to that first question, if you would like to shop around, I'll send you an email after this, and we can just talk about it, whether you're interested in looking or not. It's not any more difficult for you to shop for it. It's just a question of whether you can get a long-term care insurance policy. So thank you, everybody. We'll end it there. Take care, everybody.